we are the Cryptocurrency and Blockchain panel. We will take questions throughout the course of the panel discussion, so don't feel like it's necessary to wait until the very end. And with that, we will get started. So my name is Melissa Gomez-Nelson. I'm a partner at Dentons, and I sit in the Washington, D.C. office.
Good afternoon. My name is Brian Michael, and I'm a partner at King & Spalding in their Los Angeles office, and I'm a partner in our Special Matters and Government Investigations practice group and head up our cryptocurrency working group. And before joining King & Spalding years ago, I was a federal prosecutor both in New York and Los Angeles, and then most recently was Deputy General Counsel and Group Chief Compliance Officer at 21st Century Fox, the media and entertainment company, and so both the in-house experience as well as now obviously back at a law firm.
And good afternoon, everyone. My name is Ken Joseph. I am a managing director at Duff & Phelps and also head the firm's blockchain and cryptocurrency task force. I came to Duff & Phelps this past January, having spent 21 years at the U.S. Securities and Exchange Commission, the first 16 as an investigator, litigator, and then the last 5.5 heading the investment management examination program for New York and New Jersey, which involved, of course, all of the many of the world's largest hedge funds and investment advisors, investment companies, and the like.
Thank you. Mary Beth Buchanan. I need one that reaches. Joseph is so modest. He did not even mention one of the most key things about him, which is that his law firm is hosting the reception that we hope all of you will come to this evening.
Thanks for that plug.
Well, like Brian, I began my career in the U.S. Justice Department. I was an assistant U.S. attorney and then spent 8 years as United States attorney. Like Sally, the first and only woman United States attorney in the district in which I served. After that, I spent a little bit of time at the UN, and then I was a partner at this illustrious firm, now Brian Cave Leighton Paisner, and it's great to be back, to spend some time with some of my former partners. I left in April to join the digital asset exchange known as Kraken. The corporate name is Payward Inc., but we do business as Kraken. So it has been it's been a very exciting last couple of months, and I'm very happy to be here with you today.
Hello, my name is Federica de Santis. I'm an associate at Goodwin Procter, based in London, in its privacy and cybersecurity practice, but my broader practice is technology. So I work with all tech companies in including blockchain field, but more broadly on all fields of technology. Before joining Goodwin in London, I was an associate in the Goodwin Boston offices, and before then I qualified as an Italian lawyer based in Italy in a media and technology law firm.
Good afternoon, everyone. For those of you who maybe weren't here this morning, I'm Umang. I'm a partner at PwC, and I head up our digital and forensics investigations practice here in the UK. What I didn't say this morning is that my background is technology. And I specialize in forensic and legal technology. I'm not a lawyer, but I kind of spend most of my time working with lawyers.
Thank you, everyone. So, like many of you, I have, worked with a lot of lawyers and have family members who are lawyers and friends who are lawyers, and we often find ourselves in the discussion of blockchain and cryptocurrency. And I've come to realize that lawyers don't quite get it.
How many people here own cryptocurrency? How many people here know what cryptocurrency is if you were asked the question?
Okay. Well, you guys are doing better than most, I will say. But, with that, I think it would be helpful for the few who may not fully understand it yet, or who may not fully understand that it's not all a Ponzi scheme. So that Umang is going to give a little bit of an overview for us about the technology.
Yeah, sure. So I'll start with what blockchain is, and then we'll move on to kind of how blockchain is used, and also talk about cryptocurrency because they do relate together. I'll talk a little bit about the benefits, and then I'll hand over to my colleagues on my left to talk about some of the legal risks. So imagine a technology where records can be stored, facts can be verified, and the security is virtually guaranteed of that information. And any suspicious activity or manipulation of that information is immediately flagged. And that is effectively what blockchain technology supposedly delivers for us. So blockchain technology, first of all, it is a technology. It is a decentralized and distributed ledger. So what does that mean? What it means is in a normal situation, so for example, take your own banking records, right? Your own transactions. They will be held typically by your bank on one or two central servers by that bank, and that is the only place that information is held. They may have some backups, etc. With blockchain, the information is held in millions of different places or thousands of different places, depending on what kind of blockchain we're talking about. The information that is held in those thousands or millions of different places is effectively exactly the same. So if it changes in one area, that change has to be affected in all the different places that information is held. And typically the storage of that information is on computers, and in a lot of cases that information is stored on servers or computers held by individuals and organizations as well. And it's in an encrypted format. But what that means, that comes with a load of benefits that we'll talk about in a little while. So each record or piece of information, whether it's a transaction of some sort, whether it's information about a particular widget, is encrypted, and it's held in something called a block. Okay, and a block is basically a bunch of zeros and ones that identify that piece of information. The block itself has a digital fingerprint. So if somebody attempts to fraudulently change the contents of the block, the digital fingerprint of that block will change. And what is happening is that on a continuous basis, each computer that holds that information, it's comparing its digital fingerprint of that block, that piece of information, with all the other hundreds of thousands or millions of databases that hold the same bit of information. So that enables it to self-verify. In addition, as you add new information, new blocks are added, and the order in which those blocks are stored and appear also have their own digital fingerprint. So if you try and change the order in which a piece of information is stored, then the digital fingerprint of that order will also change. Again, what that means is if somebody attempts to change the order in which the information is stored, the computer itself will immediately know itself. And what you can get is effectively divergence. So if somebody attempts at any point in time to change one of the blocks in any particular storage location, if it doesn't match with the others, it will flag it up for you. So what are the uses of this technology? Well, it's most commonly used in the context of cryptocurrency, or most commonly known. But I'll come back to cryptocurrency in a minute because I want to just talk about other uses. I think it's really important to realize that blockchain will be and is already being used in other scenarios that are outside of cryptocurrency. So let me give an example around something called smart contracts. And if we take a simple example of a house purchase, so you've got party A and party B. Party A is selling their property to party B. They've agreed that the property transaction is going to go ahead. In the standard world, they will draw up contracts. But in this case, you would have a digital contract that is connected to a blockchain. In addition to that, some of the terms that need to be met for that contract to be fully executed, each of those points are also within a blockchain. So again, using a simple example for a moment, one of the things that needs to happen for the ownership to go from party A to party B is that the money has to exchange from party B to party A, and that money has to be received, and they need to verify that the source of those funds are clean effectively. So you can now actually create a digital contract that you set up, and as the transaction goes through, whether it's the survey, whether it's the money being transferred, as those events take place, the contract itself automatically knows that that has happened, and it will then execute the next stage itself. So you don't need a human being to necessarily verify what's going on there, including in certain cases, if done well, then the transfer of the funds as well. And then when the final transfer takes place of the funds, and everything is effectively digitally signed, then at that point, at least in the UK, the land registry needs to be informed that that property is now gone from party A to party B. And again, the contract can make that information request to the authorities to say this property is now owned by party B, and it's an automatic transaction. And so that is the use of blockchain in the context of smart contracts. Blockchain is being used in many other mechanisms, all the way from identity management. Is being looked at in the context of voting. So in most countries, still the concept of voting is still done very manually, because voting electronically has too many issues with it in terms of potential fraud. But with blockchain coming in, and by enabling individuals to be registered by blockchain and the voting to occur with blockchain technology, the likelihood of fraud can really be reduced significantly. But back to cryptocurrency, right? So what is cryptocurrency? Well, it's effectively a form of blockchain. It's a digital currency which uses the underlying blockchain technology. There is no central bank or administrator, because remember, with blockchain, all the information is held on different nodes or computers that are all around the world in hundreds or thousands of different places. So that means that the exchange of that currency can happen without necessarily a central party like a bank or a clearinghouse. It can be a peer-to-peer transaction. But that comes with some benefits in terms of speed, in terms of potential cost savings. But it does come also with some downfalls and pitfalls as well. We'll talk about some of those in terms of the risks. Now, at the beginning, I painted a picture of blockchain, which is a very positive one. You can't be defrauded, it can't be hacked. One thing that people should remember, that it's not 100% proofed, right? Like with any new technology, the criminals will always find a way to work their way around it. So, for example, one of the things that can happen is that if 51% of the computers that I was talking about, hundreds of thousands of computers, can be taken in control by one single party, then they could very easily start to manipulate the information within the database, because effectively what's going on is they have the majority of the servers or the computers under their control. They can change the information in that 51%, and then you've got the other 49%, which will then automatically agree with that because the majority is effectively winning. There's the potential in a very small network of a blockchain to have some collusion between individuals who are holding the information as well. And then there are a bunch of legal risks, which I will hand over to my colleagues to my left.
Yeah, the only one thing I would add, if I may, to that very eloquent, simplified discussion is there's a private blockchain and there's a public blockchain. So from a business and legal standpoint, I'm sure you would be worried about having your information on 1 million or 1,000 or hundreds of thousand different nodes. The private blockchain is an attempt to circumvent some of those issues. The other thing that I wanted to point out as well is that as sort of undefraudable, I just made up an English word, I think, that the system is designed to be, it is still very much very risky and fraught with fraud. That's not to say that every user or every company is indeed has a fraudulent motive behind it, but at this early stage of the technology, it is still very much a wild, wild west type situation, at least in the perception of most regulators' minds.
And as I said, at the end of the day, it's created by human beings. And so as much as it's trying to remove the aspect of trust, no need for an escrow agent, no need for the middleman, which for those of us who do FCPA anti-corruption work sounds like a great opportunity to actually use it to help mitigate those risks. at the end of the day, you still have human beings. They've created the technology, and I think we've all seen enough things that are not hackable be hacked, and it's probably only a matter of time until it gets to that point. You certainly see certain exchanges or certain more limited, entities in the crypto blockchain space rather than the Ethereum blockchain, the big broad ones being hacked. But the risk is real and it's there. And then if you think of the underpinnings of the blockchain, it was about largely this decentralized, unregulated, no central authority, anonymous world, a very libertarian view, some would even say anarchist. But if you get into the private blockchain world, or what's also known as a private ledger, you can improve the trust there by having known parties participate, not anonymizing themselves, requiring, particularly if you care about AML KYC controls, who they are, what their identity is. But suddenly now you're taking a step back really from what sort of the underpinnings of the blockchain was, and it's going to start getting back to that element of trust that, and to a certain degree, the real evangelists of the blockchain say it no longer requires trust. It just requires, understanding how to execute a transaction, and then you have this decentralized ledger that you can look to. So I think as that's evolving, and as we're going to talk about regulatory enforcement, you're seeing some of the central themes of the blockchain have to adjust to the realities of the world, particularly as more mainstream players are trying to get into it.
That's exactly right. And so as it's evolving and changing, it's all happening very quickly. And keeping up with this, specifically across the globe, is quite challenging at times. But I will say it's exciting in many ways. It's the future. And so with that, we're going to try to give a little bit of an overview of what's happening from a trends perspective across the globe. And since I'm sitting right next to Brian here, I'll start with the U.S. And Ken, please feel free to chime in as well, and others.
So I don't want to steal Ken's thunder as a former SEC lawyer, but I think the place to really start with enforcement activity in the blockchain world is with the SEC. They've been one of the most active enforcers in this space, and that's because when you deal with an initial coin offering, they've in essence determined, and the chairman, Jay Clayton of the SEC, has said there's really no coin, or sometimes known as a token, offering that in their view doesn't walk and quack like a duck like a security. And if you apply the Howey test, as many of you may be familiar with, as to what is a security, and you apply that to tokens or coins that are offered, the SEC has come down very clearly that their view is, at least they've yet to see a coin or token that is not also a security. So the expectation is that in doing an offering, you're going to comply with the U.S. securities laws. They've begun to bring some enforcement action in that space, and they're ramping up. They've also issued a lot of subpoenas across the industry, or made informal requests for information to a lot of players in the crypto and blockchain space. I think they'll tell you, if you talk to them, and I've talked to a lot of the key regulators at the commission or at the enforcement division, they're still catching up themselves and still learning, and the technology and the industry and the ecosystem is evolving so quickly, it's really impossible for them to stay up to where it is at this present moment. And that's also created a lot of tension, because the regulations are also equally as far behind and haven't evolved and are now being used to create enforcement actions in a new evolving technology, a new evolving, environment.
I actually think there are regulations.
Well, if you ask the SEC, they'll tell you that they are. And actually, I will say, though, that even the SEC has recognized that they've got to step back a bit from it. And they have softened some of the earlier statements that Jay Clayton came out with, very strong statements, almost atypical for the chairman to come out and speak the way that he did. And I think they're realizing, look, they don't want to scare the innovation away. They realize there's a lot of good actors who maybe have made missteps, because it's really hard to figure out within this ambiguous evolving world what you should or shouldn't be doing. And they've gotten more clarity from the SEC as of late. But it's still very much, there's still quite a bit of tension there.
I have to jump in here.
Please.
I do too.
So we, and I think maybe the two of us, being a former SEC lawyer and myself, I think you'll find that the two of us don't really disagree that much.
When you haven't heard my thoughts
Okay.
yet.
Right. Well, look, I disagree with the fact that there's regulation, because really there isn't. This space started to become big in the U.S. and big around the world in 2013. So since 2013, the regulators have seen that this is coming, but they haven't really done anything. So it wasn't until recently that we have the SEC even coming out to say what they think is a security and what is not. And what they have not done is come up with a set of regulations other than Howey from the 1950s that we're working with to try to figure out whether a token is or isn't a security. So I'm also going to disagree with the fact that
I wasn't endorsing their view. I was espousing what the regulator's position has been, just to.
I also think that there clearly are a number of tokens that have a real use. They have a use in an actual network that allows them to provide value and to function in that network. And those tokens are absolutely commodities. And many of those were marketed to with an exception from the SEC regulations, at the time at which they were not fully functional. And since that time, many of those tokens have become fully functional. So at the point at which they were originally sold, they may have been closer to a security, but as they have evolved, they are a commodity rather than a security. So I'm going to let my colleague jump in here. She's chomping at the bit.
So if I may get a rebuttal on these 2 points here. Look, it is true that there is no regulation that the SEC has on it in its playbook, if you will, that will ever say the word cryptocurrency or digital asset in it. It is also true that the framework for evaluating whether something is a security or not is long-standing, well-settled. The 1946 Howey case, which, by the way, applied to orange groves, right? not digital currency or anything else. A far cry from cryptocurrency, yes. But the 4-part test, which pretty much hinges on the finding of an investment contract, is the framework by which you would apply the analysis yet to determine whether the SEC, first of all, has jurisdiction over it. The Commission, and I feel strange a little bit having to defend my former colleagues, but let's just get the facts straight. The Commission could care less whether currency is being used as currency. So the original intent, and now there are over maybe 3,000 different cryptocurrencies, Bitcoin being one of the more widely known ones, the Commission could care less about currency being used as currency. Now, the IRS may have an issue, the CFTC may have an issue, the states may have an issue, and so on, but not the SEC. The SEC is most concerned about when whatever the underlying asset is being offered for sale, meeting the Howey test, to investors, period. And so I just want to make sure that everybody understands that regardless of the underlying asset at issue here, some of the same problems and benefits as well that you would find in any security offering, the disclosures, the anti-fraud concerns, the investor protection concerns, are all at play here.
And I think that's where that tension comes from, because the SEC has a mandate and a mission to protect, mom and pop investor, the Main Street investor. And you see this much money being made this quickly, apparently as easy as it at least seems with ICOs, the regulators are going to show up because they are, I think, faithfully executing their duty and responsibility to try to protect the investors. But to your point, they're applying the Howey test. They're using regulations that are meant for traditional securities offerings and applying them now to the crypto world and to initial coin offering. And as much as I agree with Mary Beth that there are utility tokens out there that have actual use and value beyond just in a trading exchange, the SEC has not yet endorsed that view. And at this point, they've made some noise that they might be softening. But, for those of us sitting in the position of having to represent clients who've received those subpoenas, requests for information, or may just want to know, do I have potential exposure? The SEC isn't quite where Mary Beth is yet. And I think that we all would like to see them get there. And there's a lot of lobbying going on, a lot of conversations going on, and it's a productive dialogue, but it's still very much, at least from the perspective of the SEC, one that they have not yet moved, I think, from my perspective, far off their original position.
Well, I'd like to talk a little bit about the landscape that we have out there, because there is some confusion about, what is a cryptocurrency, what is an ICO, what is an exchange. They're all different. So right now in the market, there are more than 3,000 tokens out there, and not every one of them is a good thing. If you look at the exchanges that are operating around the world, there are more than 200 of them. So if you went on a site, coinmarketcap.com, you would see all the various exchanges, and you would see, which ones are more liquid and which type of currencies. And then beyond about 25, when you get past 25, they're very small in their market presence. And what you would also see is that almost all of these exchanges are foreign. So we've got a handful of exchanges in the U.S. competing against 95% of exchanges in the world that are operating in places where there are no regulation. So the U.S. companies, and the company that I work with, Kraken, is one of these companies that is trying to get it right in the absence of regulation. And what we have seen, the little that we've seen from the CFTC and from the SEC, is regulation by enforcement. That is what it is.
Are you surprised?
No, not at all. I mean, with the CFTC, for example, they came out in, I think it was 2015, and said that virtual currency is a commodity.
And just to add for folks, the CFTC is the other most active, I would say, federal regulator in this space right now, and have, as Mary Beth has said, have made some bold pronouncements, typically through their enforcement activity.
But it's not as though Congress came out and said cryptocurrency is a commodity, and therefore we will give the CFTC jurisdiction over this commodity. That is not what happened. The CFTC decided upon their own that they were going to call this a commodity, and they were going to take over the regulation of this particular asset. And so they didn't just say it. What they did was they started to put companies out of business because they were not registered with the CFTC. But the problem here was that there was no way for these companies to become registered with the CFTC. So they were just picking them off one by one and putting them out of business because they weren't registered. So what the exchanges did was make sure that they operated in a manner that was outside of the Commodities Exchange Act, so that they were no longer operating, within that jurisdiction.
And they've been emboldened by a couple federal district court decisions that have found that the CFTC does have jurisdiction over cryptocurrencies, or that they can be, under certain circumstances, a commodity. You have a decision in the Eastern District of New York and the District of Massachusetts very recently. So it's emboldened them quite a bit because they're having these victories in court as well.
So let me contrast the
Even though it
SEC
hasn't been a
approach.
fair fight, apparently.
Let me contrast the SEC approach. The developments in this area began with some very public statements by Chairman Clayton, the Division Director of Trading and Markets, and then the first really foray for the Commission in this space was with the Dow 21A report. What does that mean? They did an investigation, they decided not to charge, but they issued a report nevertheless, which outlined, as far as the SEC is concerned, what a coin offering looks like and what rules are going to be applied. They often mention how we test. The subsequent series of cases, if you really look at it, in addition to the continued speeches about it, the feature of what a coin offering, a fraudulent coin offering looks like on the Commission's landing webpage.
I think they created a token as well.
They created a token, Howey token, or something like that. But it was all in an effort to increase awareness. And then a series of enforcement cases came. See, I told you.
That's the SEC calling. They're pissed at us.
Series of enforcement cases ensued, which focused on those offerings that were, in my view, on the extreme end of things. These were not really close calls here. These were squarely within the fraudulent activity spectrum. The latest series of cases have moved to the gatekeepers, the unregistered broker-dealers, and other gatekeepers. You wouldn't be surprised, the lawyers, for example, who may be advising some of these companies to proceed with offerings without registering them or qualifying for an exemption, or otherwise registering as a broker-dealer in order to offer securities. FINRA, the SRO, has recently gotten into the act and actually brought an enforcement action against a FINRA-registered person for offering unregistered securities that was in the form of an ICO.
Just
Well,
last
again,
week.
let's
Just
take a
last
few.
week.
Let's take a few steps back. Okay, you know, the SEC, and I do think they did the right thing by not trying to charge anyone in the DAO, creation and hack.
You should
But-
just pause that
Yes.
they did the right
Well,
thing.
they did the right. Wait a second.
And for those
but
of you who are
if-
newer to this
for-
space, you should read this DAO report.
Yeah, so DAO means decentralized autonomous organization, which meant nobody was in charge. And so the creator was not in the US. So while they did the right thing, I think that they wouldn't have been able to do anything else. But they did a good service by trying to explain what in their view would be a security. Nonetheless, they've gone forward and they have prosecuted some of those outliers who are clearly violating the securities laws. And most of the cases that have been brought have been people who have made wild claims about the speculative nature of what this coin will do and why it is such an investment. Well, that's exactly a security. So they are going after the bad actors in this space. So while it is instructive to show coin developers what they should never say, before they release a token, it still isn't really providing, clear guidance. And with this issue of being registered as a broker-dealer or an automated trading system, well, that's a good idea, assuming that the SEC would allow developers to register these coins as securities. So right now, you've got a lot of companies going out there, getting these licenses, but unless you have something that is registered as security, you can't trade it on your ATS. So again, we're lacking regulation, and the U.S. has in the past not been shy about creating regulation, except here in this instance. So we've had at least 5 good years where they have not, really done anything.
Well, and I think the idea of guidance is precisely on point, where you have a lot of companies who are our clients in private practice, or companies like Kraken, who they're out there, they want to do the right thing, they're trying to navigate all these various jurisdictions. And so we spoke a little bit about the federal side. Do you all want to talk a little bit about the state side and how the New York AG is working in DFS perhaps a little bit?
Let me set the stage a little bit because I think Mary Beth's going to have something to add on this point. The New York Attorney General, and as not surprising, in New York, you have state regulators in this space, first of all, and there's state registration or licensing requirements that are out there. And in New York, they've taken a very aggressive position on this and put themselves out there, starting principally first with the banking regulator, the New York Department of Financial Services, DFS. And certainly the New York AG or aspiring governor wasn't going to be left behind and decided that they were going to get into the mix as well, and recently issued a voluntary information request to some of the biggest exchanges out there, including Kraken, whose CEO kindly said F you to the New York Attorney General's office. That's my perception.
Is that a legal term?
That's the legal term. That's my perception. I'm certainly not speaking for Mary Beth on that, but refused to provide that information. And ultimately, as a result, a report came out a couple weeks ago by the AG's office in which they, took all this information in, and then there were 3 exchanges that they referred to DFS for not being registered in New York, even though Kraken apparently doesn't do business in New York, and one of them was Kraken.
Yeah, so this needs to be put in perspective as well. I mean, theoretically, every state in the country could issue regulations and attempt to regulate cryptocurrency transfer. They could do that. Some states have, most of them have been taking sort of a hands-off approach. But New York decided that they would create a licensing regime called the BitLicense, which there are a few exchanges that are registered, and Kraken made the conscious decision not to attempt registration in the state of New York at that time. And since that time, they have refrained from doing business in certain states that it just was not, when you do a cost-benefit analysis, it's not worth sort of the regulatory hurdle to do business in these places. So when this request for voluntary information came out, it was right before I came on board at Kraken.
Would you have advised your CEO to say something different?
No comment. I think that the request was styled as a voluntary request for information.
We've all received those voluntary requests
But
from
it was this information was demanded within 2 weeks. So that doesn't really sound very, very voluntary. And to give a little color on this, these exchanges, particularly the U.S. exchanges, we receive daily requests from law enforcement, not just in the U.S., but around the world, because we do business globally. So these may be requests in federal criminal cases, they may be terrorism cases, other types of national security, and we have to process all of these requests and provide information to law enforcement, which we do on a daily basis, and we work very closely with regulators in these types of cases. So here, Kraken made the decision that we don't do business here. This is not a place where we want to spend our time and money complying with this. Maybe had it been asked in a different way, like truly voluntary, come and help us, then maybe they would have made a different decision. But if you look at those exchanges that did voluntarily comply, they certainly weren't rewarded for that either, because the New York AG just decided to publish this opinion and slap everybody around. So regardless of whether they do business in New York or not, whether they complied or not, the New York AG seemed to have some unkind words to say for every exchange.
Let me add some more important points from the Japanese legal point of view. Japan has legalized cryptocurrency in the early stage, and we have a serious problem because Japanese exchange platform has been hacked recently, and there are so much damages for the public. But people don't go to the US because it is regulated. And the Japanese regulation is fairly weak. And there's no market manipulation sanctions or insider trading sanctions at all, because the Japanese government does not take the opinion that it is not security or even the commodities.
And that's a great segue.
That's a real problem. And you see that actually that many people are now concerned that actually hacker is North Korea. And even if from the national security point of view, Japan do not want to deal with North Korea. North Korea's hacking team systematically attack Korea and Japan and get huge money out of the market.
Well,
there's no protection for the ordinary investor, for common people who made an investment through those cryptocurrencies. That argument should be emphasized, I think, more, because it's also a concern to the national security of the United States and also the other world. Because even if the United Nations prohibits transactions with North Korea can get the free money through that sort of the cryptocurrency money. And also, the problem that this industry, the people don't like regulation at all. When the Japanese FSA started to regulate those groups of people, they immediately moved to the Malta, where there's no regulation at all.
Right.
Well, I'm glad you raised this point, because Kraken actually was involved in helping the victims of the Mt. Gox hack, and we continue to work with the trustee today to help refund money to the victims. And it's also appropriate for a shameless plug for Kraken that of these hundreds of exchanges, Kraken and Coinbase are the top two for security. So security is really a very high priority. And I think Japan is leading the way now by creating a comprehensive regulatory scheme so that that exchanges would be regulated.
And that's a great segue, just to talk a little bit about some of the other regions across the globe. And I know, Federica, if you want to talk a little bit about the UK and Europe generally.
Yeah, and actually what is interesting hearing from what Brian and Ken were saying before is that, in the US the approach is that, well, it looks like a security, let's regulate that as a security. In the UK we had more, I would say, technical approach. So currently there is no regulation for this kind of activities because it's really a technical point. So cryptocurrencies are not included within these specified activities or specified investment under the Financial Conduct Authority regulatory box. So the conclusion was that these kind of activities don't fall within the current financial regulations. And so likewise for utility tokens, they are just like digital access to services and applications. They are not really security, so let's not regulate them currently. So this was the position, I would say, is the position currently, but the UK has been studying really hard the subject matter, first of all, to gain the expertise, to understand what the technology is, what are the risks, what are the benefits, and at the same time, trying to understand what is the right model, the right regulation for this sector, especially because, of course, there are security concerns, certainly, but another concern is also making sure that investors invest in the technology, and so making sure that they have the confidence and bring the money in the UK for companies established in the UK. And so the current proposal in the UK is exactly to extend the current financial regulation to currency exchange platforms and operators in this field. So trying to stretch a little bit the existing regulation and apply it to these operators, including, of course, making sure that the initial coin offering are, provide all the information to investors, that advertising that you may often see in the UK, in London subway, is not misleading. So soon this may be regulated. And also making sure that people, as Mary Beth was saying, they may have the right redress, and so making sure that there are like sort of insurance schemes or redress mechanism. It's also interesting that the UK has been like sort of looking around to see what is the right model. So they've seen Japan, they are seeing states like, for example, Malta and Gibraltar, which are pretty interesting cases where actually there is regulation. So very recently they enacted this sort of digital, basically blockchain licenses for the operators, distributed technology ledger licenses, whereby companies just abide by certain principles. So it's a quite flexible regime. And what has been said now in the public, what is happening is that many companies, either in the US or in Asia, are just moving and changing location, relocating in these kind of countries, because at the end of the day what companies really want is regulatory certainty, which currently of course is not the case in the UK, but is, from what I'm hearing, is also not the case in the US. And so I think the discussion that really are happening now is what kind of balanced regulation can really be introduced while at the same time protecting consumers. And also making sure that whatever regulation is introduced is not dead and old when it is, created, like it happened for, data protection with the GDPR and other kind of legislation where they were, in some respect, already old when they've been enacted, because it's a technology that's evolving every day. So coming back to the UK, there is I think hearing, in the market, a call from operators themselves to be regulated, because they want, at the end of the day, regulation, a clear guidance from the regulators. Another development, which is also just, I think, worth mentioning in Europe, is the Anti-Money Laundering Directive, which the fifth Anti-Money Laundering Directive, which will be states have a implementation date in January 2020, and the new thing is that the currency exchanges platforms and the custodian wallets for cryptocurrencies will be subject effectively by law to AML requirements. And so even if today this happens already on a voluntary basis, it will be law, so there will be a legal requirement to identify suspicious transactions and to to identify customers and to report suspicious transactions.
And in the U.S., along those lines, FinCEN has been active in this space and has brought some enforcement actions for failure to implement or maintain proper AML KYC or failure to file SAR, SARS, suspicious activity reports. And so that's another area of enforcement risk and activity here in the United States.
Yeah.
So, go ahead.
Sorry,
No, go ahead.
Yeah, we have approached the problem like I said before, as we would any other asset class, with the same sort of needs and issues. There are evaluation needs, there are compliance needs and custody needs and AML and KYC needs. There's liquidation and wind-up. There's cybersecurity needs. We've heard from the audience about some very famous hacking incidents in this space as well. And at the tail end of it, there's liquidation and monitorships and receiverships and so on that are at issue. In the case of hacks, there's also a huge need to try to trace where the assets were transferred to. And as public as the blockchain is, it is traceable to some extent. You could at least get it. I see some disagreement in the audience. It is traceable to some extent.
And how to self is a data type, even if you trace that's no meaning at all.
Right. There's been some work done to try to solve that problem, but I mean, it is designed to be public yet anonymous, which seems to be an oxymoron in and of itself.
Well, if the exchange is trying to get it right, what they're required to do under the anti-money laundering requirements is to have the wallet addresses registered so that they verify in advance where the digital currency will go if it ever moves off the exchange.
So speaking about some of the other, going back to the global trends, if you will, Mary Beth, have you seen any advantages from an in-house perspective to operating in one region more than another, or how has it been in your experience?
Sure. I think that Federica got it right, that the exchanges that want to comply with the law, we are not afraid of these regulatory schemes in other countries. And so right now, you do have Japan, which has introduced a series of regulations that would regulate exchanges. You have in Abu Dhabi, they have a comprehensive regulatory scheme that was published in advance, and people in the industry made comments, and then they made revisions to this scheme. Finally, in Singapore, they have not yet enacted regulations, but they have published guidelines, which again, members of the industry have commented, and they will regulate not necessarily the exchange, but they will regulate the activity. So if it's the activity of buying or trading or transferring, that's what they're regulating. Whereas with Abu Dhabi and Japan, they're actually going to regulate the exchange.
And I think Ken just gave you a laundry list of things that would keep any compliance officer or general counsel, fully engaged 24/7 for as many days as they could fill, given how much work needs to be done. There are technological tools out there that are being offered. I think even in the space, you have the actual entities that have the know-how within their companies are building out their own controls as well. So you're seeing a balance. It's not clear yet what will sort of meet the needs and how regulators, when they do come knocking, because right now, I think, as was said, they're going after the low-hanging fruit. There's a lot of obvious bad actors out there. But at some point, those worlds could, merge where folks trying to do the right thing, there's significant loss or number of victims. At what point will the government say, well, what you did was good enough, you tried hard enough, or you fell flat and fell short, and we'll hold you accountable?
Yeah. Question in the back.
So, go ahead.
I just want to defend the model of regulation by enforcement.
Are you an enforcer?
I was full disclosure enforcement director of CFTC in 2015.
Excellent.
And brought the case against Ericsson. And at the time, you had the blockchain industry that was the first industry that was ever begging to be regulated because it wanted to get out from the shadow of Mt. Gox and the whole idea, the whole image of crypto as haven for money laundering, drug dealers, and terrorists. And the decision by the committee the CEA has an incredibly broad definition of commodities, so there's no question that as a matter of law, crypto fits into that pool. And the idea of, and I think this is something that you touched on earlier, that idea of having the whole regulatory rule writing process where you issue the draft and there's comment period and then it's challenged. When you have a industry that is evolving technologically this quickly, I mean, it's obsolete by the time the interest rise. So there is really no other rational, practical model than bringing cases with the CFTC. At least you have orders that are speaking orders that kind of spell out what the expectations are. So I'm not really sure that this is some kind of gotcha scheme that the government, is trying to perpetrate against the blockchain industry.
Yeah, I thought that was you back there.
I take back everything I said about the CFTC.
I do think that there is a responsibility on the part of the regulators to work with those in the industry to come up with a set of regulations that make sense. And I do think that, again, there has been a little bit of gotcha out there, particularly when there is not a way for some of the companies to operate within the old sort of schematic for other types of commodities. So there's work to be done on both parts, and there are a lot of really good, serious companies out there, U.S. companies trying to get it right, and we would like to have the opportunity to see this technology stay in the U.S. and not follow all the flockers to Malta. And in doing that, we would like to work with regulators in coming up with something that makes sense, rather than regulators sort of looking for someone who's doing it wrong. I mean, certainly the people who are doing it wrong should be prosecuted.
I mean, but Mary Beth, have you found that the regulators are receptive to that? Because, in fact, I think your successor, Jamie McDonald, who's now the head of enforcement at the CFTC, who's a former colleague of mine, has made it known that he welcomes the opportunity to talk to, the Krakens of the world. Certainly the SEC, having created their new cyber section, has lawyers there. I was recently talking to Ken's former colleague, who's the head of exams for the San Francisco regional office of the SEC. She too has said she welcomes those opportunities. So I do think there is an avenue there, and I'm curious, Mary Beth, if you've had success in that.
Yeah, no, I think that's right. I mean, I haven't, we haven't engaged yet with the new enforcement director, but that's a great idea. I can't. I do think that the SEC is
you're a much better
definitely,
looking guy than JB, though.
They're trying to get it right as well, and they are uncharacteristically open and helpful. Yeah. And yes, I think that they're doing a great job right now trying to work with the industry, and I hope the CFTC follows suit and
So let me just maybe make 2 points on that. One is, look, I've been around for every financial crisis that has occurred in the last 21 years on the regulatory side, and I can't tell you the number of times I've heard that's regulation by enforcement for the accounting cases, the reinsurance cases, the .com cases, every single one of them, and we are where we are today. The second thing I would say is, yes, indeed, I think even at the SEC, as they regulate, they're also opening the door to industry. There's a chicken and egg problem, I think, where clearly there are a lot of folks who want to get it right, but as of right now, you go in and you lay it out, there's really no guarantee that what you're laying out may not ultimately end up in an enforcement investigation at a minimum, or an exam somewhere down the road. So while I encourage folks to take advantage of that open door, I also encourage, especially the lawyers and the accountants and the other gatekeepers, to understand what the regulatory framework is and to advise your clients accordingly. If you're involved in a securities offering, I don't care whether it's cryptocurrency, water bottles, whatever it is, there's a regulatory framework that's in place that, until it's changed, we need to comply with that.
Are there any other questions from the audience?
Where are we with the central banks
So the question was, where are we with central banks?
I mean, that would be a great irony, right? It's exactly what the creators of cryptocurrency and the mythical Satoshi who created it were trying to avoid in the first place. And so that might be their worst, nightmare come true. But there aren't any central banks that have issued a digital currency yet. And candidly, I haven't seen anything that I think is on the, anywhere near to that. But it's certainly something they're exploring and looking at.
The other part,
Yeah, I mean, some have looked at it, but I think when they start really thinking about it, it's very hard to make it fit within the world in which they operate. I think, it's the innovators who are going to figure out how to fit with some regulatory evolution that we obviously need.
the other part of the irony is, forget central banks for a moment, but I think there are several governments who recognize the power of the underlying technology, the blockchain technology. So whether you end up with a crypto or not, the technology clearly has uses that ultimately may survive.
We've done work with two governments now. I can't say which ones, but two governments now where we've helped them conduct a study on what digital currency of the future might look like. And it's a case of kind of how quickly can we get there and how quickly can we build the confidence.
But isn't the bigger story ultimately the blockchain and what it's going to create in terms of opportunities?
Exactly. I mean, you can, for part of this discussion, you could say, actually, it's never going to happen. It's all very negative. It's all very risky. But the underlying blockchain technology brings huge amounts of benefits. And just as another example, like in the healthcare space, to be able to validate the authenticity of particular drugs, right, through blockchain is going to have huge amounts of value. So we mustn't forget the underlying technology.
Yeah, and just adding that, as Umang said, it's more in other fields of the business rather than payment itself, because there is also sort of widespread, also in the UK, opinion that really you are not using cryptocurrencies as a means of payment, because like retailers, almost like us, they don't really accept the Bitcoin or Ethereum or whatever. So it's more about trying to unleash the power of technology for like supply management or other fields, rather than really right now as a means of payment. It's not really mature. And there is also an opinion at the G20 level, international level, that there is no real risk of financial stability right now due to these features.
Well, I told you I used it to get into my football pool.
We're coming up on time, so I think we can take one more question, if there is one.
Yeah, I mean that's the concept of mining Bitcoin as an example. It's hugely expensive and hugely energy inefficient, and in some ways, Bitcoin as a cryptocurrency is a commodity because there's limited supply because of that, right? So you kind of get to the underlying reasons of why there's a value to it and why the demand is there. But ethically, yeah, I mean, in some cases, the dollar cost or the pound cost of actually creating a Bitcoin can, depending on the value at a particular point in time, can be more than
I'm sorry,
the cost.
No. I was just saying that expensive to mine and power hogging to mine has actually created some opportunities in some dying towns, especially in the New York area I'm familiar with, that have cheap hydroelectric power imported from Canada. Thank goodness for the new NAFTA, which has revitalized.
It's not called NAFTA anymore.
I know. Has revitalized. I wouldn't acknowledge that. Have revitalized those towns as some of the crypto miners have moved into long abandoned warehouses and factories and so on.
Look, it's a supply and demand, and I think as long as it's there and the technology improves, it will continue.
So it looks like we managed to keep everyone awake. So that's a success. Thanks to all of our panel members. Thank you.